December 28th, 2025. While most of the world is focused on the holiday season and the closing of another calendar year, a quiet panic has gripped the highest levels of the New York financial district. We are witnessing what can only be described as a systemic bank run on the physical silver markets. According to the latest internal audit data from the commodity exchange, known as Comex, something unprecedented occurred during the first 4 trading days of this month. 60% of the total registered silver inventory was claimed, processed, and moved out of the vaults. To understand the gravity of 60% vanishing in 96 hours, we must look at the actual numbers. The registered category represents the physical metal that is specifically designated to back the futures trading system. It is the only silver available for delivery to those who hold paper contracts. At the start of December, those vaults held approximately 150 million ounces. Today, that number has plummeted toward levels that threaten the very existence of price discovery in the Western world. This is not a typical market fluctuation. In a healthy commodity market, silver moves in and out of warehouses in a predictable, balanced flow. But what we are seeing now is a unidirectional exodus. Large institutional players, sovereign wealth funds, and industrial conglomerates are no longer rolling their paper contracts forward. They are demanding the bars. They are demanding the physical metal. They are taking their silver and they are leaving the system. The math is simple and terrifying for the exchange. If 60% of the available supply can be drained in less than 1 week, the remaining inventory provides a window of only a few days before the cupboard is completely bare. When the registered inventory hits zero, the Comex officially fails as a delivery mechanism. At that moment, the paper price you see on your television screen becomes a fiction. It becomes a number that represents a metal that the exchange simply does not have. We have spent decades operating under a fractional reserve pricing model. The system assumed that for every 100 ounces of silver traded on paper, only one person would ever ask for the physical delivery of a silver bar. That assumption has died in December 2025. The global elite and the massive industrial consumers have realized that in a world of structural deficits, a paper promise is not the same thing as a physical asset. They are rushing for the exits, and the door is not wide enough for everyone to get through at once. As we approach the end of the year, the question is no longer if the system will break, but what remains of your purchasing power when the music finally stops. The catalyst for this sudden acceleration in physical demand can be traced back to a single official document issued earlier this year. The United States government officially designated silver as a critical mineral under federal strategic resource classifications. This was a fundamental shift in policy that altered the global financial game forever. Before this designation, silver was viewed by regulators primarily as a precious metal for jewelry and investment, or a byproduct of industrial mining. By moving silver into the same category as lithium, cobalt, and rare earth elements, the government admitted that silver is now essential for national security, economic stability, and supply chain resilience. When a commodity receives critical mineral status, it triggers a cascade of institutional behaviors. First, it authorizes the federal government to begin strategic stockpiling programs. Second, it signals to every major corporation that securing long-term physical supply is no longer just a matter of cost, but a matter of survival. According to Federal Reserve economic research on commodity market structures, such designations historically cause a massive shift in how institutions hold inventory. The old model of just-in-time delivery is being abandoned in favor of just-in-case strategic reserves. Companies like Tesla, Samsung, and First Solar are no longer content with buying futures contracts on an exchange. They are now moving silver from registered status to eligible status at unprecedented rates. To understand why this matters, you must understand the distinction. Registered inventory is the metal available for delivery against paper trades. Eligible inventory is silver stored in approved warehouses but owned by private entities who have withdrawn it from the tradable pool. When a tech giant moves 1 million ounces from registered to eligible, they are essentially telling the market that this silver is ours, and it is never coming back to the exchange. This strategic imperative is being driven by the realization that China currently dominates many of the global supply chains for critical minerals. By designating silver as a critical resource, the United States has entered a global arms race for physical metal. This has created a massive incentive for American institutions to front-run government purchasing programs. They know that once the government starts building a national silver stockpile, the available supply for private industry will shrink even further. The designation of silver as a critical mineral was the final signal the market needed to confirm that the era of cheap, abundant silver is over. We are no longer looking at a simple investment asset that moves based on interest rate expectations. We are looking at a strategic resource that is vital for the military, for the energy transition, and for the entire technological infrastructure of the 21st century. The mathematics of the vault drain tell us that the big money has already read the memo. They are not waiting for $80 silver to start buying. They are buying now because they understand that in a world of strategic mineral shortages, the price is secondary to the possession. To understand why the silver market is fracturing, we must examine the internal mechanics of how prices have been set for the last 50 years. The global silver market operates on a fractional reserve pricing model, a system nearly identical to how modern banks function. When you deposit $100 in a bank, the bank does not keep $100 in the vault. They keep perhaps $10 and lend out the rest, assuming that every depositor will not show up at the same time to ask for their cash. The Comex silver market has functioned on the exact same assumption. For decades, the volume of paper silver contracts traded daily has dwarfed the actual amount of physical silver sitting in the vaults. In many years, the ratio of paper claims to physical metal has reached levels as high as 100 to 1, or even 500 to 1. The exchange assumed that most futures traders were merely speculators who would settle their contracts in paper currency rather than demanding a heavy box of silver bars. This system worked perfectly as long as silver was seen as an abundant industrial byproduct, but that assumption has officially died in late 2025. When silver is designated as a critical mineral and a structural shortage becomes obvious, the fractional reserve model collapses under the weight of actual delivery demand. Think of it as a game of musical chairs, where there are 100 people dancing, but only one chair in the room. As long as the music plays, everyone is happy. But the moment the music stops, 99 people are going to hit the floor. The drainage of 60% of the registered inventory in just 4 days is the sound of the music stopping. The primary reason this model is dying is the loss of fungibility. In a normal market, a paper-silver contract is considered as good as physical metal because you can easily convert one into the other at a known price. However, when physical premiums explode and the metal disappears from the vaults, paper silver and physical silver become two completely different assets. One is a legal promise from a clearinghouse that may or may not have the inventory, while the other is a strategic industrial asset held in a private vault. As more institutional buyers realize that the Comex may not be able to fulfill its delivery obligations, they are rushing to be the first ones to claim what is left. This creates a feedback loop of scarcity. Every ounce removed from the registered vault makes the remaining paper contracts more risky, which in turn causes more holders to demand delivery. We are no longer watching a market in price discovery. We are watching a market in a liquidity trap where the fractional reserve leverage is being forcefully unwound. The death of the paper pricing model means that for the first time in half a century, the true value of silver will be determined by those who own the metal, not by those who trade the paper. In a functioning global financial system, there is a fundamental law called the law of one price. This law is maintained by arbitrageurs, specialized traders who find price differences between two markets and trade them until the gap closes. It is essentially free money, and in a digital age, these gaps usually last for only a few seconds. However, since October 2nd, 2025, the silver market has been screaming that something is fundamentally broken. We have entered a state of persistent backwardation that has lasted for over 2 months. To understand the scale of this chaos, we must look at the arbitrage opportunity currently sitting on the table. December futures contracts have been trading at approximately $78.80, while the immediate spot price trades near $79.40. That is a 60-cent gap per ounce. In the world of institutional silver trading, a single contract covers 5,000 ounces. This means there is a risk-free $3,000 profit available for anyone who can buy the cheap paper contract and sell the expensive physical metal. In any other year, thousands of traders would flood the market to capture that $3,000 and the gap would vanish instantly. But the gap has not vanished. It has stayed open for 60 days. This is a flashing red alarm. The only reason a $3,000 arbitrage opportunity stays open is because one side of the trade is impossible to execute. Traders cannot find physical silver for immediate delivery at the quoted price. The metal is simply not there. According to research from the Bank for International Settlements on commodity market stress, persistent backwardation coupled with high lease rates is the ultimate proof that paper markets have decoupled from physical reality. The futures market is failing its primary job of price discovery. If you cannot buy the physical metal to satisfy the trade, the price on the screen is nothing more than a ghost. We are seeing a situation where the paper market says silver is worth $79, but the physical market says, I do not care what your screen says, you cannot have my silver for less than $87. This failure of arbitrage is the final stage of market breakdown before a complete reset. It proves that the big bullion banks, which traditionally provide liquidity to the market, are no longer willing or able to part with their physical inventory to close the price gap. They are hunkered down, protecting their own reserves and leaving the paper shorts to twist in the wind. When the arbitrage mechanism fails, it means the invisible hand of the market has been cut off. We are no longer in a period of price volatility. We are in a period of structural disintegration where the paper exchange is losing its ability to influence the real world. While the Western paper markets are struggling with internal failures and inventory drains, the physical markets in the East are sending a loud and clear signal to the world. On December 24th, 2025, the Shanghai Gold Exchange recorded a physical silver premium of $8 per ounce over the New York futures price. This is not just a minor discrepancy. This is a massive divergence that reveals where the real price discovery is now taking place. For decades, the world looked to New York and London to determine the price of silver. But in this current crisis, the East has stopped following the West. When buyers in Shanghai are willing to pay $8 more than the quoted price on the Comex, they are effectively telling the global market that the New York price is a fake. It means that if you want actual physical silver bars delivered to your vault today, the starting price is not $79, it is $87. This $8 premium is the highest in the history of the modern silver market. It represents a complete loss of faith in the Western pricing mechanism. According to analysts who monitor global metal flows, silver is now moving in a massive one-way tide from west to east. Arbitrageurs are trying to buy whatever metal they can find in London or New York to ship it to Shanghai to capture that $8 profit. But as we discussed, the vaults in New York are already empty. The metal is being trapped in the East because that is where the real industrial demand and the real capital are located. Furthermore, the Shanghai market has entered its own state of acute backwardation. This confirms that the scarcity is not just a Western phenomenon, but a global one. However, the difference is that the Chinese market is a physical first market. They do not rely on the same level of paper leverage that New York does. When there is a shortage in Shanghai, the price simply goes up until the metal appears. In New York, when there is a shortage, the exchange tries to manage the price through paper selling and margin hikes. This shift in the center of gravity for silver pricing is a historic turning point. It suggests that the era of Western financial institutions controlling the price of industrial commodities through paper derivatives is coming to an end. The Eastern markets, led by China and India, are demanding physical settlement and are willing to pay the necessary premium to secure the metal. For an American investor, this means the price you see on your local news is lagging behind the reality of the global market. The $8 Shanghai premium is a window into the future. It is a preview of the price that New York will eventually be forced to accept once its vaults are completely empty. The most dangerous misunderstanding in the silver market today is the belief that higher prices will significantly reduce demand. In economic terms, we call this price elasticity. For a luxury item like a diamond ring or a silver necklace, when the price doubles, people simply buy less. But in the world of 2025, silver is no longer just a luxury. It has become a non-negotiable industrial requirement for the technologies that drive modern civilization. Approximately 70% of current silver consumption is now driven by applications that are completely price inelastic. Take the solar power industry as the primary example. In 2025 alone, solar panel manufacturing consumed 665 million ounces of silver. Each gigabyte of solar capacity requires approximately 20 tons of silver for the conductive paste that makes the cells function. There is no viable substitute. You cannot use copper because it oxidizes and loses efficiency. You cannot use aluminum because its conductivity is too low. If a solar manufacturer cannot get silver, their billion-dollar production lines simply stop. For these companies, paying $80 or even $150 per ounce is a minor cost compared to the catastrophe of a complete factory shutdown. The same logic applies to the electric vehicle sector. Each electric vehicle uses significantly more silver than a traditional internal combustion engine for its complex electrical systems and battery management units. With global production accelerating toward 90 million vehicles annually, the automotive demand for silver has become a structural pillar of the market. These are strategic industrial shifts that have been planned for a decade. A car company cannot suddenly redesign its entire electrical architecture because the price of silver went up. They must have the metal regardless of the cost. Furthermore, we must consider the emerging demand from artificial intelligence server farms and 5G infrastructure. These high-performance circuits require the unique thermal and electrical properties of silver to manage the massive data loads of the modern era. In these sectors, silver is a tiny fraction of the total build cost, but a critical failure point if it is missing. This creates a situation where industrial buyers will continue to bid the price higher and higher just to secure the physical supply they need to stay in business. According to analysis from the Silver Institute, we are reaching a demand destruction point that is far higher than most analysts predicted. Because the vast majority of silver is consumed in small amounts across millions of high-value products, the end consumer barely notices the price increase. A $50 increase in the price of silver might only add a few dollars to the cost of a high-end smartphone or a solar panel. This means the demand will not fall even as the price surges toward triple digits. We are in a structural trap where the world needs more silver than it can produce, and the buyers are wealthy enough to keep paying more until there is simply nothing left to buy. The crisis we are witnessing at the end of 2025 is not a sudden accident. It is the mathematical conclusion of 5 consecutive years of a massive global supply deficit. To understand the gravity of our current situation, we must look at the cumulative numbers that Wall Street has consistently ignored. Since 2021, the world has consumed more silver than it has produced every single year without exception. By the end of this month, the cumulative shortage is projected to reach a staggering 820 million ounces. Think about that number. 820 million ounces of silver have been pulled from above-ground stockpiles to fill the gap between what the mines produce and what the world demands. For 5 years, the global market has been living off its savings. We have drained the private vaults in London, we have emptied the exchange warehouses in New York, and we have depleted the industrial reserves of major manufacturers. We have reached the bottom of the barrel. The data from the Silver Institute shows that in 2025 alone, the projected deficit is 95 million ounces. But here is the problem that most investors miss. Mining production is extremely slow to react to higher prices. It takes a decade to bring a new silver mine from discovery to production. Even with silver approaching $80 an ounce, you cannot simply flip a switch and create more metal. In fact, the total new silver supply expected to come online over the next 10 years is estimated at only 44 million ounces. That is not enough to cover even half of a single year of our current deficit. This is a classic supply and demand trap. On one side, you have the industrial giants who need silver for survival. On the other side, you have a mining industry that is physically unable to increase production quickly enough to matter. According to World Bank commodity analysis, when an essential industrial commodity enters a sustained deficit with inelastic demand, the price must rise exponentially until it reaches a level that forces consumers to stop using it. When you look at the mathematics of 820 million missing ounces, you realize that the silver market is no longer a trading market. It is a liquidation market. We are watching the final ounces of available silver being fought over by the most powerful institutions on Earth. The registered inventory at the Comex is the last line of defense, and as we have seen, that line is breaking. You cannot argue with arithmetic. If you consume more than you produce for 5 years, eventually you run out. We are at that point right now. The math says the price must go higher, not just to reflect inflation, but to reflect the simple reality that the physical silver is gone. When silver prices surge, the financial media instinctively looks back to the most famous event in the history of the metal, the Hunt brothers' silver squeeze of 1980. Nelson Bunker Hunt and Herbert Hunt attempted to corner the market by accumulating nearly 2/3 of the world's privately held silver. Their buying drove the price from $6 to an all-time nominal peak of $50 per ounce in just a few months. But while the price action in 2025 may look similar, the underlying mechanics could not be more different. And that difference is why this current crisis is far more dangerous for the global financial system. The 1980 rally was driven by a single family using massive amounts of leverage and debt. It was an artificial cornering of the market. Because it was driven by speculation, the regulators were able to kill the rally by changing the rules. On January 7, 1980, the Comex adopted Silver Rule 7, which restricted new long positions and effectively forced traders to only sell their holdings. This, combined with a sudden hike in margin requirements, crushed the Hunt brothers. There was no actual silver shortage in 1980. There was only a shortage of silver available to the people the Hunts were squeezing. Once the leverage was removed, the price collapsed back to $10 because the industrial world had plenty of metal. Now, look at 2025. We are not watching two billionaire brothers trying to manipulate a market. We are watching the entire industrial base of the 21st century fighting for survival. You can pass a rule to stop a speculator like Bunker Hunt, but you cannot pass a rule to stop a solar panel manufacturer from needing silver paste. You cannot margin call the United States government's strategic mineral stockpiling program. You cannot force liquidate the demand from 90 million electric vehicles. This is not a speculative bubble built on debt. It is a structural deficit built on a physical lack of atoms. In 1980, when silver hit $50, Americans began melting down their family silverware and coin collections, creating a massive new supply that helped break the squeeze. In 2025, the price has already surpassed $79, yet the supply response is nowhere to be found. The easily accessible silver has already been recycled over the last 5 years of deficit. The mines are already running at full capacity, and as we have seen, they cannot increase production for another decade. According to historical analysis, the 1980 peak was a moment of peak greed. The 2025 surge is a moment of peak necessity. When the Hunt brothers' squeeze ended, the exchange survived and the pricing model remained intact. But today, because the demand is coming from essential industries and sovereign governments, the exchange has no relief valve. If they implement emergency restrictions today, they will not be stopping speculators. They will be announcing to the world that the Western financial system can no longer provide the critical minerals required for the modern economy. The Hunt brothers tried to break the market for profit. The 2025 crisis is breaking the market by reality. As we stand on the final days of December 2025, all eyes in the financial world are locked on the January 2026 delivery calendar. Historically, January is considered a minor delivery month on the Comex, meaning most traders usually roll their positions forward to March or May to avoid taking physical possession. But the data appearing on our screens right now is anything but minor. January 2026 is showing record high open interest for this time of year. This suggests that a massive wave of traders is not planning to roll their contracts. They are standing for delivery. This creates a mathematical collision course with reality. As we established, 60% of the registered inventory was already drained in early December. If the holders of the January contracts demand physical metal at the current rate, the Comex will face a total inventory exhaustion event within the first 2 weeks of the new year. When the number of silver ounces demanded for delivery exceeds the number of silver ounces sitting in the vault, the exchange enters a state of default. This is the endgame that every precious metals investor has speculated about for 40 years, and it is now manifesting in real time. What are the options for the exchange when this moment arrives? Option 1 is to let the price rise until it reaches a level where enough buyers voluntarily walk away from their delivery requests. But as we have discussed, industrial buyers who need silver for their production lines cannot walk away. They will pay any price. Option 2 is to implement emergency measures, similar to a force majeure, where the exchange forces a cash settlement. This means they tell you, "We do not have your silver, so we will give you $80 in cash instead." If the exchange chooses option 2, it is the day the paper silver market dies. A cash settlement is an official admission that paper silver and physical silver are no longer the same thing. It tells every investor in the world that a silver futures contract is just a bet on a price index, not a claim on a metal. This would trigger an immediate and violent repricing of physical silver in the private markets. If the Comex settles for $80 in cash because they have no metal, the price for a physical bar in the real world might instantly double to $160. According to analysts who study exchange failures, the transition from paper price discovery to physical price discovery is rarely peaceful. It is usually marked by a total suspension of trading and a permanent loss of credibility for the Western financial system. We are watching the institutions prepare for this right now. The record delivery interest in January, despite depleted inventories, is a sign that the big money is trying to get through the door before it is locked. The January delivery cycle will likely be remembered as the moment when the global pricing system for silver finally fractured beyond repair. As we enter this new era of silver pricing, the most critical question for every investor is no longer how much silver you own, but what kind of silver you own. The events of late 2025 have proven that we are entering a great decoupling. The days when a paper silver certificate, a futures contract, or a digital exchange traded fund were considered equal to physical metal are over. To navigate the coming months, you must understand the difference between a claim on silver and the silver itself. If the Comex moves toward cash settlement or emergency restrictions in January 2026, holders of paper silver may find themselves trapped. You might see the price of silver on your screen soar to $150. But if your fund only pays you out in cash, based on a frozen exchange price of $80, you have lost the race. According to historical precedents of market failures, the spread between the paper price and the physical price can widen to 50% or more during a liquidity crisis. This is why institutional smart money is draining the vaults right now. They are converting their paper promises into physical bars while the exit is still open. Let us look at the long-term valuation of silver to understand where this is going. If we take the 1980 peak of $50 and adjust it for 45 years of currency debasement and inflation, the fair value and current purchasing power is approximately $194 per ounce. At $80, silver is still 60% below its historical inflation-adjusted high. When you combine this valuation gap with the fact that we are in a structural supply deficit that did not exist in 1980, the case for triple-digit silver becomes a mathematical necessity. For the individual investor, the strategy should focus on two pillars: custody and counterparty risk. Physical silver held in your direct possession or in a fully allocated, segregated vault outside of the banking system is the only way to ensure you benefit from the coming repricing. You must eliminate the middleman. Mining stocks may offer significant leverage, but they also carry operational risks and are subject to the volatility of the broader stock market. During a systemic financial crisis, the most valuable asset is the one that has no counterparty risk and is essential to the global economy. Silver fits both descriptions perfectly. The mathematics of the 60% vault drain, the $8 Shanghai premium, and the 5-year supply deficit are undeniable. We are watching the end of a 50-year experiment in paper price suppression. The transition will be volatile, and it will likely be marked by exchange failures and government interventions. But for those who hold the physical metal, this is not a crisis to be feared. It is the greatest revaluation of a strategic asset in our lifetime. The $80 threshold was not the ceiling. It was the floor for a new age of silver. As the world realizes that paper cannot run an electric vehicle or power a solar grid, the true value of the white metal will finally be revealed. The end game is here, and your positioning today will determine your purchasing power for the next decade. H1.1